Welcome to the Tax EndGame with Mark Kanakaris from Cherokee Tax Group. As an advanced tax strategist and enrolled agent licensed by the Internal Revenue Service, Mark is uniquely qualified to go deeper into the revenue codes than most accountants. He understands and interprets the provisions on how you can legally save on your personal, trust, and estate taxes. Now you can reroute those wasted tax dollars. Mark provides business owners, professionals, and individuals the guidance they need to prepare their taxes today for better tax planning tomorrow. Using a solutions-driven and unique holistic approach, Mark breaks down the loopholes around tax planning and preparation along with must-know financial planning and tax reduction techniques. Listen in as we tell you what no one is going to tell you about taxes. Now, on to the show.
Short and long-term capital gains. What should you know? Well, this is the place to find out. Welcome back to the Tax EndGame. Host Mark Kanakaris is about to explain the differences to me and why they're important. I'm Patrice Sikora. So, Mark, first, let's define capital gain. What is a capital gain?
Sure. A capital gain is going to be any sort of investment where you have either achieved a profit or a loss, but it was something that was designed as an investment. So like a company buys inventory, it's not an investment. Yes, they're going to take that inventory, either resell it or make it into another thing and sell it that way. That's not a capital gain. Traditionally, capital gains come from the sales of like stocks, bonds, mutual funds, annuities. Maybe you bought a rental property or a house to flip or just a piece of land that you thought you were going to retire on. You sell it. That would all fall under capital gains. The intention needs to be to make a profit.
All right, but what's the difference between the long and the short then?
It's just time frame. So the short-term capital gains or anything that's under a year and anything that you've held for more than a year becomes a long-term capital gain. And this is where real tax planning starts to jump in. So let's start with some short-term, capital gains. And, I always think of those guys who are flipping a house every couple of months. So when he buys a house for a couple hundred, he puts 100 into it, he sells it for 4, he's going to have a short-term capital gain of 100,000, and it's going to be subject to the full taxation. It's treated like a W-2 income. There's no phase outs on that stuff. So if I bought a house and I sold it and I make $1 million, I'm going to be taxed on every bit of that $1 million. I can't really defer any of that stuff off. So that's going to be a short-term capital gain. It is the highest tax gain. And, people people who are swing traders or day traders on the stock market, those guys see that. And we're talking about stocks and investments. Your own investments can create short-term capital gains. Now, there's an exception to the rule with dividends, and we'll cover that. But for the most part, for people who like to trade, they're going to constantly experience short-term capital gains. And that's a double-edged sword.
Why would they do it if they know they're going to make a profit on the stock perhaps, but that's a pretty hefty tax bill.
It's not a perfect system, but if you're a short-term trader and you don't want to buy and hold and go through the ups and downs, I get it. Some people have the argument of don't let the tax tail wag the profit dog. And some people see that in reverse. I'm an active trader with our investment practice. So I see on my personal accounts a lot more short-term capital gains. But inside an IRA, a 401k, any of those retirement accounts or deferred accounts, none of that applies. So that's the good news. So where that becomes really important is when you're working with an investment guy, and if he knows what the heck he's doing, and he's going to put you in something that can create capital gains, your deferred accounts are your best place to be. One of the number one things I hate seeing is guys who come in here and they've got money in non-qualified accounts getting hit with short-term capital gains. And we still haven't even talked about phantom income yet.
Oh, that sounds like a movie.
Yes, it probably should be The Phantom Income, starring John Travolta as the villain. And we'll get Matt Damon to play the hero.
We can do better than that. All right, so that's short term. What about long term?
Yeah, long term is what a lot of people do. It's when you buy and hold something for more than a year. A long-term investor with non-qualified money, he's going to have that, but that's a double-edged sword. That's almost kind of like becoming a deferred investment. And a lot of people get caught up in long-term capital gain profits, and then they don't know what to do. So there is no perfect answer. And that's where obviously I'm going to suggest tax planning comes in. And, we'll have to come back and make sure we don't forget about tax harvesting. But like I have a client that's in here right now, and he's got $1 million long-term capital gain. And I said to him, well, what was your profit target to get out of this investment? I don't have one. When do you plan on selling? I don't know. You're 68 years old. You don't have a lot of options. You either take the hit or defer it forever and hope it's still a profit for your kids to inherit. But you only have 35 more years to worry about that one. And I don't know how these funds will do because I don't have a crystal ball. Neither do you. So you've got to kind of do some planning when you recognize your games. Actually, you should do a lot of planning when you recognize your games, and definitely have an advisor who understands that and looks at your tax return and says, hey, it's time to recognize these. But there are a loophole or two here where we've got some clients like the guy I'm working with now, where we can take advantage of some of these, gains and, keep the taxes to a real minimum.
Well, so this is not just for wealthy people to worry about.
Absolutely not. I mean, I have a client of mine who just sold a piece of land, right? She made $70,000. Now, if she was married, she wouldn't have paid any taxes on it, but because she was single, she got taxed on some of that money. Now, when she sold this piece of land, obviously she had a cost basis, what she paid for the land. She had now land's a little bit different. You have to do real improvements, like install a road, just cutting the grass and property taxes. They're not deductions, but when you improve a property, you put a bulldozer on it, you knock down trees, or you put in a road, that's a real improvement that you can add to the cost. Same thing for like a rental property. When you do permanent improvements that can't be taken away, like you put in new flooring and new kitchen cabinets, you put on a new roof, those are permanent upgrades to a home. Even your personal residence that would count. I mean, I would argue to an IRS agent that if I have a home and I put a $20,000 roof, my cost basis on that house just went up $20,000. I can't take the roof with me when I move.
All right. Now you mentioned cost basis twice there. Tell me about that.
This is what it costs you to get the investment. If you put 10 grand into a stock and it goes to 15,000 and you sell it, you're going to have a $5,000 capital gain. You're not taxed on the 10 grand you bought it with, you're taxed on the profits. Now, the funny thing is you can have a mutual fund do the reverse. So I have a client of mine, he's a recipient of a trust fund. And during the one of the big pullbacks, it was either 2018 or maybe it was 2015, and he came in and he had a $30,000 loss, the value on the account. He says, yeah, the account went down 30 grand, but I have this funny form saying I have to recognize a $15,000 profit. I didn't get any money. I was like, I know. Welcome to phantom income. So after he gave me a few choice words of frustration, most of them being 4 letters, I said, hey, here's the thing. The mutual fund manager, who you have no control of, probably sold off all of his winning positions. Let the losers continue to lose because they could be dividend stocks that he's going to buy, that he's going to keep reinvesting his dividends into. And you got hit with all of his winners. Phantom income, because you're right, you didn't see a penny. The thing went down and he just sold off all of his winners. That's phantom income. And it can happen at any time with no warning. And that's kind of the double-edged sword when you deal with stock mutual funds. You could get hit with that and not even know. Now, granted, in a deferred account like an IRA, 401k, that never hits because it's in a deferred account. But when you have non-qualified money, you're really playing with fire. And the bigger the account, the more fire you're playing with.
And now what about the dividends? You were talking about the fund manager would have reinvested those, but what if it's your dividends?
So dividends have their own special tax rate, and this isn't a whole dividend cast table. I'll just cover a couple of things with dividends that people, I think they fail to realize. So let's talk about a non-qualified account, which is where you're going to see taxes. So there's qualified and non-qualified dividends. Basically, if you buy a company that's here in the United States, it's considered a qualified dividend. You're going to get a little bit special tax treatment, save a few bucks. If you buy some company out of Europe that pays a dividend, you're going to not get that you're not going to get that preferential treatment. Now, when a non-qualified account, which is, most people take those dividends and reinvest it to buy more shares, and that does up your cost basis. And thank goodness for computers today, because in the old days, you had to try to keep track of that stuff. It was a disaster. I mean, nobody knew what they were going to, what was going to really happen, because that was really tough to figure out what your real cost basis is. So, dividends in their own animal. I mean, dividends are great things to have. It depends, but depending on your tax bracket, you can have dividends in a non-qualified account as long as you're not at a high tax bracket. So, because with the dividends, could be almost useless. And I'll tell you what's really funny. I have a client that's the ex-vice president of Starbucks, and he had $85,000 a year in dividends, and we actually had it set up where he paid 0 taxes.
How did you do that?
Because I'm just darn good. So it's where we got the rest of his income from, came from sources that weren't going to be taxed. So he could take all those dividends and live off of those, which is what he did, pay his bills, go out golfing, everything else. And he had some other cash in other accounts that were not taxable. And, for about 40 years, he paid no taxes.
Tell me about some other possible, I won't say loopholes, but loopholes.
Well, one of the things people don't understand is that capital gains and losses, they do offset each other. And this is kind of important. So, nobody wants to take a loss, but I'm pretty sure everybody has and will. But when you take a loss in an IRA, there's no tax value at all. So if you have something in your IRA and you lose 15 grand, you don't get a tax benefit. But in a non-qualified account or a brokerage account, as I like to call it, there is some advantage. So I had a client who walked in one time and he had a $200,000 long-term capital gain. Well, now the law says we can use that against any gains, long or short term. So let's say that this year he had 15,000 in gains, and he's a married person. We can use those carryover losses and offset that year's gains, and we can take an additional 2,000, give him a small deduction. The bad thing comes when you get older in life and you have those big deductions. If you don't use them, you're going to lose them when you pass. Granted, your spouse may keep for a while, but if she doesn't know what she's doing with it, and your tax preparation guide isn't his job, it may not be of any real value.
How long can you hang on to those and use them? Is there a window?
And so you use them up or die. So those carryovers can hang around for a while. And then they had some rules for a while where you could go back a few years, and that kind of stuff seems to change from time to time. I don't see too many capital losses anymore for some reason. The economy's been so good for a while. Most of the losses you see are very, very small. So no one's walked in. But, sometimes you can use it to do Roth conversions and other stuff. It just depends on what you have available.
I know you really didn't want to talk about it, but tell me a little bit about the tax rates.
Well, it's always double for single versus for married. So if you are a married person, up to under $80,000 of income, you have a zero tax rate on capital gains. It'll be half of that for a married person. Most of my clients probably have an income between 80 and 500,000, so they're going to pay usually 15% on capital gains, and that's what most people are told. I also remind folks, don't forget, just because you passed on federal, I'm here in Georgia. We have a state tax. State tax can still bang you for some of that stuff. And when you're recognizing, like this guy with $1 million, we're talking about recognizing $100,000 of gains this year. And lucky we'll be able to do it for about 7 cents on the dollar. That does include state taxes, where on another state, maybe a Florida, he could have that. Maybe he pays 5 cents in the dollar. So sometimes the state you live in gives you a little bit of break on those capital gains, at least the larger capital gains. The small ones, I always say most states, they like to keep their retirees in a certain income range with no real taxes to the state, because they just want you there to live, and you pay property taxes and, your state, your sales tax on stuff. So they don't want to bang you too much. But if you're wealthy, they're going to come after you.
All right. So besides being married, what are some other things that you can do to mitigate those taxes? And tell me more about planning too.
Well, there's always, we call it tax harvesting. So at the end of the year, my clients with non-qualified accounts, we give them all a call and we say, do you have gains? Do you have losses? And maybe we'll intentionally sell something that's at a loss to offset some gains. And there's a thing called a wash rule. So if I sell an investment at the end of the year, because there's a loss on it, I can't buy that back for 31 days if they like the investment. So I can get around the wash rule and let that be recognized. Day 32, I can buy it all back. So we can take the deduction, especially if they think the stock might come back, or mutual fund, bond, ETF. You can do that. Now, bonds have an interesting approach where if you overpay for a bond, let's say that, typically a bond costs $1,000. There is a special rule. Let's say you paid $1,300 for the bond, that you can amortize that $300 overpayment as a loss over the 10 years, or take it when the bond comes due. But those people who buy bond mutual funds, they throw all those benefits out. Those all disappear when you buy the bond mutual funds. It's kind of a downside of bond mutual funds, but we're not really here to talk about that today. But those losses, at the end of the year, most financial guys, they don't bother to call their clients and say, hey, which ones do we want to recognize this year? Let's use some of the losses to offset some of the gains and step up our basis. Now, if you keep an investment till death, then great. The basis, as of right now, today's loss, basis becomes the value of the stock on the date of death, and then your heirs can get around it. But that means if you're, anywhere under, I'd say 85 and you're still alive, you put that investment at risk to anything just to try to get out of some taxes. Most people don't realize that the tax bracket is better for them to recognize it and pay the taxes, even if they stick it tax-free municipal bonds secured by the government, where at least you're getting your money back and that they're hard to overpay, traditionally, of course, and bypass those estate tax laws.
How difficult is it to take a look at your holdings and set up a decent program? This sounds like a lot of bookkeeping, a lot of keeping your eye on things. What does it take?
I think the problem is it comes from most financial guys don't understand taxes, and most tax guys don't bother to look at their clients' investments because they don't get paid to do it. And that's why we're such an incredible practice. We do both. So all I do is I start taking my clients' statements around the end of usually their December 1st statement. And I go and I'll call them and say, I'm going to sell you out of this, or I'm going to leave this, or I'm going to do that, because I'm going to pick up some tax, deductions for you. And we'll just get you back in at the end of the year. Now, everybody else may hold this investment a little bit longer because they're in a deferred account. So they want the remainder of the gains, but maybe I'm trying to offset some of those gains with some losses from a tax perspective. Most people that I work with tend to, I try to explain to them, you need to invest your money right. If you're trying to control your taxes, putting money in a non-qualified account is not the brightest idea unless you have no other place to go. But there are tax shelters that you can use where you can still make a fair rate of return and not pay taxes ever or until you need to. And if you need it for long-term care, well, then that's great. Pull it out of that account because now you got something to write it off against.
Mark, we went through dividends, cost basis, capital gains versus losses, how many years do you have to wait, tax harvesting. Is there something else we need to touch on here?
Gosh,
Besides a lot.
I would just say it's so important for the planning. And when you retire and you've got investments, this drives your tax return. In retirement, your number one expense is going to be taxes. And you can't tax plan when you have wild cards. Like my clients come in and I'm working with some folks now and I'm like, listen, guys, until I know what income you want to live on in retirement, tax planning is a waste of time. And if you've got non-qualified income, we have to talk about how to control those investments so that, we don't get hit with, some wild card. Because if I tell you somebody, we're going to Roth convert $39,000, because that keeps their tax bracket. And all of a sudden, some mutual fund bonehead goes out and gives them a $15,000 capital gain. Well, crap. We just pushed a lot of money into a whole new tax bracket, and we're paying more over something that we nobody bothered to control. So one of the things I like to do is when I'm talking to my clients and they're coming on for taxes and investments, explain why certain money could be here. I say this, you can win the tax game or the financial game. It's always tough to win both, unless you're under the right circumstances. And usually basically means you're in really low income. So you sort of win at both, but anybody with any real savings and they're not using a real talented tax planner, they're just glutton for punishment. I mean, eventually the IRS is just going to send the gorilla down and just take it all because they don't know what to do. And the problem with most people, especially the do-it-themselfers, and I have nothing against do-it-yourself. Like I like to fix stuff around my house, but there's some things you got to leave to the professionals. And yeah, I'm sure there's a couple of guys out there that do a pretty good job managing their money, but when it gets to be a lot of money, you have to have a tax financial guy handle the bulk of it, or at least the part that's driving the problem. So I got a client coming in, he's got two problems. He's got a couple of $1 million in an IRA, and he's got $1 million long-term capital gain. And I'm going to sit down with him tomorrow and say, look, I think you need to let me control the IRA, and you can distribute the capital gains as I tell you, and we can start getting out of this and reinvesting for the future. And maybe if you want to be a long-term investor, then great. After I'm done Roth converting, we'll come back to whatever capital gains you have, and we can deal with them again. And sometimes the most important thing to do, depending on how your accounts are set up, is just do split returns. So I have a client we're doing split returns on. We're going to put capital gains on the wife and Roth conversions on him. And of course, we have to send some notes to the IRS to let them know that she's recognizing the capital gain, not her husband. So we'll send in a special form for that. So the IRS doesn't go bill him thinking he didn't pick up his half. And we're going to have to tell the IRS she's picking up the full burden of this and the husband's picking up, other parts.
What's the thinking behind that?
Well, because of her income, she could recognize her income is so low, we could get a lot of these capital gains at 0%. And we could Roth convert him, and we'll just do Roth conversion on him, and we'll be able to pay about I think it's about little over 7%, 7 cents on the dollar on Roth conversions, which is a cheap Roth conversion. Because, if you can Roth convert at 7% and you got a halfway decent financial guy, you should make your money back the next year. You didn't slow down, but on a little part of your portfolio, because he's not going to Roth convert $1.8 million, not without buying some advanced tax deductions, which is not the scope of today's conversation, but one for the future for sure. But, without buying some advanced, or there's a couple other things you could do on long-term capital. You could defer. There's a few things out there now where you can defer the gains for about 7 years. That window is going to close. I think it's 2026. It's going to close now. So maybe it's 6 years, but there's a few things coming up that you could still do where you could push off the cap. You could sell out of your investment and then push off the capital gain till that time. And then you would recognize it then, which in theory, hopefully you've made more money and you could set aside some funds for those capital gains. But, on $1 million, you better make a couple $100,000 because your tax bill is going to be pretty damn high.
All right. Mark, how can people reach you to talk more about this?
Always give us a call at the office, 678-981-6331, or just email me direct to Mark.K at CherokeeTaxGroup.com, and just put, podcast in the subject line, and we'll set up a time to do a free consultation, talk about what's going on. I always remind folks that we do have a special confidentiality with our clients, not quite to the level of attorney, but everything that says between an accountant is privileged to some extent. So you don't have to worry about us, calling your church and saying, this guy should be donating more to your church, that cheap son of a gun. So, anytime, we're here 9 to 5, Monday through Friday, like most everybody else.
One resource, folks, for all your questions about capital gains and a lot more, too. Mark Kanakaris of the Cherokee Tax Group. Make sure you know when new episodes of this podcast are ready for you by following, and of course, share with friends and colleagues. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to the Tax EndGame with Mark Kanakaris, the podcast that shows you how to win the tax game. Have questions about topics covered during the show? Visit www.CherokeeTaxGroup.com. Email us at info@CherokeeTaxGroup.com or email Mark directly at Mark.K at CherokeeTaxGroup.com. You can also call us at 678-981-6331 to set up a free consultation. Don't forget to click the follow button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and or guests and does not necessarily represent the views or opinions of Cherokee Tax Group. The content has been made available for information and educational purposes only. The content is not intended to be a substitute for professional tax advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your individual situation.